Hi to all. So in this video, we will cover the concept of crossover rate, which may be or may seem a little bit complicated, but as soon as you see the video, you will realize that the calculation of the crossover rate is quite simple. What I would say is a little bit more challenging is understanding um, um, uh, the concept of it and why we have a crossover rate and what the crossover rate is. But I think with a couple of minutes we will be clear on that. Okay, so let's refresh that we have been talking about the net present value and about the internal rate of return. Here we have two projects, so we will start with project A right here, right? And for project A, we are already experts, so we know how to get the IRR and we also know how to get the NPV with the Excel shortcuts. IRR, right? We just select all of the cash flows and we use the IRR command. Because this is a conventional cash flow, it means there is one cash outflow in the very beginning, the initial investment, and then everything is a cash inflow. We are not concerned about having more than one IRR, and we're not concerned about having to use a modified internal rate of return. So we just calculate the IRR. We can then calculate the NPV, and we know NPV is NPV, future cash flows. And I'm sorry, we need to give the Excel the rate first, the rate, then the all the future cash flows, and then we add the initial investment. I mean, we subtract it, but because this is already negative, we add it. We add this cell, which is negative, so we're subtracting the initial investment. Now we have the NPV. Now let's look at, or let's prepare this data table where we will say, okay, let's calculate the NPV for project A and let's look at the NPV profile. So let's just look at different discount rates. I'm gonna just have them all here. And then let's ask Excel when we choose all of this. We select data, what if, data table, column input cell. What we are telling Excel is I want you to calculate this formula that I'm giving you on the top cell, on the top of a column. And I want you to do this by changing this discount rate. And instead of using this discount rate, you will use one by one each one of these rates that I am providing here, and then you will give me the NPV for each calculation with each one of these rates, and there we go. We have this. So I have already set up the figure, and as you can see, we have project A here, and this is the NPV profile basically of the NPV profile of project A. So we already know the meaning of the internal rate of return, which is, well, the internal rate of return is that rate that makes the NPV, the net present value, equal zero. So if we look at this rate is going to be close to this number, so close to the 13%. And we can quickly see as long as we look at this data table, we see that after 13%, then the next value is negative, so 13 point something. As a matter of fact, we have it here is 13.21849. So if I change this to 13.21849, we end up with zero, right? So that's the IRR, and it means that if we use that discount rate, if our discount rate is this, then the net present value is zero. Now, another important intuition about this is, now these are the discount rates. And if my project, another way of thinking about IRR is, well, the IRR is also the holding period return for the project or the yield of the project. If we're buying the project and we're waiting until maturity, until the project is liquidated, I mean, until we receive the last of the cash flows, and that is the internal rate of return. So another intuitive way of thinking about the IRR rule is if my internal rate of return, so let's call AKA yield or return, just return, is greater than the cost of funds, we take the project. NPV will be positive. You see the point? IRR, we can think about IRR as well as the return that the project is ultimately giving, that the investor is achieving with this project, given the investment and the future cash flows. So if the IRR is greater than the discount rate, we choose the project. And NPV will be positive. Is that true? So what we are saying is, let me move this a little. I'm gonna keep it there. Actually, I'm gonna make it smaller. So if the return IRR is greater than the cost of funds, right? So that's the same as if the cost of funds is smaller than the return, we take the project. NPV is positive. So if we look at the chart, this is exactly what we can see in the chart. When the internal rate of return is positive, right? It means when the internal rate of return is greater than this discount rate, then we are in this range here. And in this range here, right, the cost of the funds are still small and they are not any higher than the internal rate of return. And also the net present value is positive. And the IRR is still greater than the discount rate because once again here in the x-axis this is the discount rate and the discount rate is smaller than the IRR. How do we know this? Well, because the IRR, we know it's here. It's 13.2 something. Now, if the discount rate of the project, which is the case when we go past this point here, is greater than the 13 point something, which we can see here, like if the discount rate is 14, 15, 16, 17, 18, so these discount rates are greater than the internal rate of return, then the cost of funds, discount rate, cost of funds, is greater than the internal rate of return, than your than your profitability, than your return. Don't quote me on this. This is not an exact definition, but an intuitive way of thinking about this. And because the cost of funds is higher than your return, then you reject the project. The NPV is also converging here. The NPV is negative. So we're moving a little bit forward to from what we knew before. Okay, so to the left of the internal rate of return, we are accepting the projects. That means discount rates that are to the left of IRR. And discount rates that are to the right of IRR, we can no longer accept those projects because the NPV goes negative. Now, this different projects will have different IRRs. Okay, so for example, let's look at project B. IRR, and we look at IRR here, it's 15. It's a little bit higher than project A's IRR. Let's calculate the NPV as well. We only select the future cash flows. We need to give Excel the rate, comma, then future cash flows plus initial investment. There we go. Now, let's look at the NPV profile of project B. So we do this by referencing this cell where we calculated the NPV on the top cell. And then let's just ask Excel to calculate this table again, but also including this project B now by changing this rate here. Now, what we have is we in this second graph, it's just plotting this table. Now we have project A, which we already have before, but now we have project B. So for project A, if the discount rate is lower than 13%, the IRR, we are taking the project. If the discount rate is lower, if I'm sorry, if the discount rate is any higher than the 13%, we are dismissing the project. And project B, this happens much later. Project B, the internal rate of return is 15.75. So we reject the project. The project, it crosses zero after 15.75. So this is interesting. Number one, when the discount rate is 14, we dismiss project A, but we still accept project B. When the discount rate is 15, we dismiss project A, but we still accept project B because project B's IRR is 15.75. Okay, so there is a point, there are some discount rates in which we accept project A, we reject project B, and there are other discount rates in which we accept project A, but we reject B, and there are some projects in which we accept B, but reject A. Now, most importantly, and this is lurked through this figure, this, what I have been saying, is relevant if we are deciding, okay, am I accepting or rejecting project A? So you're only paying attention to project A. Then let's look at project B. You're only paying attention to project B. But in some instances, you want to choose between two projects. And if you're choosing between two projects, of course, you will choose the project with the higher net present value. That's a good way of choosing between two projects using the NPV. Is just, well, the project with the higher NPV. Remember, the higher NPV means the higher, a high NPV means that the present value of future cash flows is much higher than the initial investment, right? So when we are comparing these two projects, then there is one crossover of the two NPV profile lines, NPV plotted lines, and we see that there is this point that we can see here visually in which the two projects have the same NPV, so you are indifferent. You can choose either of the two have the same NPV. But before this crossover rate, project A is better than project B. But after this crossover rate, project B is better than project A. So, do you choose project A or project B? It depends. What is the discount rate? Okay, so maybe you have, let's assume, and I will give you this example, rates today are 9%. So the discount rate is 9%. Let's assume the um, treasuries, that's a very high number, but let's assume it for this, for illustration here. Treasuries are 9%. Well, you have these two projects, you're likely to choose project A. But what if there is an announcement that the Fed may increase the rates in the next hour to 14%? And this is just a very random, I'm choosing very random numbers. Then you would very likely, you would like to wait until you have the new rate, because if this is not true, rates remain in 9%, well, you're better off with project A. But if this is true and the rates go up to 14%, then you will no longer take project A, but you will take project B instead. And that is the crossover rate. That is that rate at which the two NPV profiles cross over, and then the decision changes. Project A, in this case, is no longer the optimal one. And after the crossover rate, project B is the optimal one. Now, quick, how can we calculate this? The calculation is quite simple. Step one, we get the differences at from between each one of the cash flows. So project one minus this project, project A minus project B, and we just get the differences for all of the cash flows. And then step two, we get the IRR of these differences. There we go. So that is the crossover rate. The crossover rate is 11.1035. Now let's keep in mind that at this crossover rate, the two projects have the same net present value. You're indifferent between the two. If we just write here 11.103586, you will see that the two projects are having exactly the same net present value as presumed, right? And as is, it is evident here in the chart. So this is how we calculate the crossover rate. I hope this was helpful, and thank you for your attention.